for joining us. My name is Scott Wolf, and I'm the host of this first installment of Speaker Series. Speaker Series is a recurring live video series offered as a community service by local members of the Church of Jesus Christ of Latter-day Saints. Features members of the church who are residents of Northwest Calgary and who are experts in the area of their presentation subject matter. I'd like to point out that although the series is presented by members of the church, the subject matter is not religious and the events are open to anyone interested. Today's presenter is Steve Kunn. Steve is an investment advisor for a major Canadian bank. He's been advising in the investment industry for 15 years, and he holds the industry's most distinguished designation, CFP, or Certified Financial Planner Professional. He also holds the Chartered Investment Manager designation. Steve will be presenting some foundational financial concepts that will help you be successful and plan for a financially sound future. I've known Steve for more than 20 years, and I look forward to hearing from him this evening. Steve will give a short presentation and then he'll take questions at the end of the event, but he won't be giving any specific financial advice on specific investments. Feel free to post your questions in the chat and Steve will answer as many as possible at the end of the presentation. Just before handing things off to Steve, I'd like to point out that Speaker Series presentations are informational only, and while the presenters in this series are often paid professionals, they are not compensated for their participation here, and this presentation is not intended as a solicitation of services. And so with that, I'd like to hand it over to Steve Kunn.
Thank you, Scott. Good evening, everyone. It's a pleasure to be here and speak on something that I'm absolutely thrilled about to speak about. I did want to say thanks to Scott Wolf. Without him, there's no way this technology would have worked. And he certainly helped us bring the speaker series that we're trying to put together up to a new level. So I'm grateful for what he's done. I'd also like to thank my local leaders, particularly my bishop, Bishop Brad Harker. It was his idea to put this together, and I'm just thrilled that he's done this for us. I'm also grateful that they chose to do a topic on financial planning. This is a topic that has been of great interest to me for many, many years. And frankly, I'm humbled that they have chosen me to speak about this. On the first slide, you'll see a picture of a bunch of trees.
Stand by.
So hopefully, now they said people have sent me a message saying that we've lost some audio.
All right, folks, had a little bit of a technical difficulty there. I think we're back on. Steve, I think we lost the audio when you started to talk about planting a tree, and right now we've got the slide up that says when's the best time to plant a tree, and you can take it away.
Sure. So hopefully I don't repeat myself, but the idea is that today is probably the best time to plant a tree. Obviously, the best time would have been 30 years ago. My challenge today for myself was to try and inspire people. My goal for you is that you'll have one idea that you'll be able to collect and work on. And so I want to encourage you to try and work on that one idea, and hopefully I'll provide a few for you. I prepared a bunch of topics for you, 7 really. Each of them I could probably spend about an hour going through, but I thought I'd pick just a couple of them. And then if you have any interest in some of these topics, feel free to ask any questions through the chat, and we'll do our very best to get to as many of them as you can. The one I wanted to start on is when should you use debt? It's a very common question, and in today's world, it's very, very common for all of us to use debt because of how readily it's available. It's easy to get a line of credit, it's easy to get a mortgage, it's easy to get a credit card. And so the way I look at debt is I use an acronym, which is ROI, return on investment. Meaning if I use credit or debt to fund my goal, will it meaningfully add to my life? Or I should say possibly improve my net worth. I feel that buying a home, getting an education, and buying a business are very expensive and long-term plans. And if I needed debt to get through those or to accomplish those, I feel like the return on investment would be very high and also very likely. Other options, such as, say, purchasing a vehicle, buying furniture, weddings, home renovations, or just using credit cards for just basic consumer goods. Some of those, although I'm not suggesting that a wedding isn't a good return on your investment, I'm just saying that some of those items, you could probably trim it down so that it fits in your budget. You might be able to delay some of these purchases. You might be able to find other options. Maybe you don't need the most expensive furniture. I think there's always something on Kijiji, but some of these expensive consumer goods are usually what get us into trouble. So yes, debt's great, but we really need to look at it as a return on our investment. If you find yourself in debt, I suggest that you turn to 2 sources. Someone that can understand you, hear you out, comfort you, educate you. The other would be maybe say somebody that can actually help you in terms of maybe a debt counselor or maybe a personal banker, like a lender, possibly somebody that might be able to help you consolidate those loans. One point that I think is worth mentioning right now, interest rates are so low that you might want to look at doing a debt consolidation loan with your lender, your banker of choice. What I mean by that is, let's say, for example, you have a car loan and a furniture loan and another loan for maybe an old loan for, say, post-secondary education. And each of those have varying different interest rates and different balances. With low interest rates right now, if you walked into your bank, it's quite possible that you would be able to probably reduce your interest by half, keep your payment the same, and that would speed up your repayment plan dramatically. So hopefully you're not in that situation, but if you are, now is probably a really good time to consider getting a debt consolidation loan. Another topic that a couple people brought up to me was all about how can you help your children learn about finances. This is this is a personal topic for me. For those of you who know me, I have 4 daughters, and I really, really try and instill in them the value of a dollar. But it's hard. You have to stay really consistent at it. One of, I think, the best ways is to expect your children to help out around the house. If you pay them an allowance, ensure that they earn it. Don't just give them an allowance with the understanding that they just get an allowance just because it's now the 15th of the month, but instead rather lay out what their jobs are and then pay them accordingly. Uh, Nowadays, it's hard to say pay your child 5 loonies and have, maybe 2 or 3 little piggy banks that the child could then put in and save up for various things. Most of us don't carry cash or change. We might have to check the bottom of a junk drawer now, or maybe a cup holder in your car to find the change. So instead, try to do something more virtual. Now, children can have checking accounts and even savings accounts. Children who are over the age of 12 can actually have a mobile app that allows them to sign into their banking. They can see how much they have in their checking account and their savings account, and they can even do the transfer back and forth themselves. I think one of the best things my wife and I have done with our girls is opened up checking accounts and savings accounts. It's linked to our banking. So when I log in, I can see their banking. I can tell when my daughter's gone to Max and bought a Slurpee and used her debit card. That's great to know. When she signs in, she can't see our banking. She can just see her banking. So I think that's a really great approach. When it comes to paying her allowance, we simply just move the funds into their checking account. So it makes it a little bit easier. And frankly, most people don't use piggy banks anymore. So it gets them into using technology that they'll probably likely be using for the next number of years before something new is invented. It's nice that that you can see their various accounts online. It's nice that the kids can see it as well. And when the funds come in, you can actually help them figure out what they're going to do. Maybe they were a goal-based saver, and maybe they move funds into something for longer term, short term, and keep it in checkings. One of the things I do is we have a family RRSP set up. I'll get to that probably later. And I often encourage my children when they get funds into their checking account is to move funds into their RRSP. And I explain how it works. One of my daughters knows that every time she puts $1 in the RRSP, she's getting a 20% grant from the government, and she just loves it. I'm pretty happy that my little 10-year-old or 11-year-old now understands that. I think it's also important to teach your children to give back, both in terms of how much time they have as well as how much money they have. Giving back and paying forward makes a lot of sense for a lot of people. And it does something inside people that it's hard to quantify, but it does just change people for the better when they give back. One more point on this, and as I said, I could probably spend hours talking about each of these topics, is in my humble opinion and just anecdotal observation, people are either spenders or they're savers. Now, if you're a saver, it becomes hard to spend, but you can learn to do it. It's probably better off if you are a spender, a saver. But if you are a spender, you can learn tricks to be a saver. Now, for those who tend to be savers, sometimes they can feel anxiety about money. And sometimes when they're little and parents are involving them in decisions, and sometimes if they don't understand the full picture, they can feel like it's possible that you are spending too much money and you're going to run out of money. And that could create anxiety for them and possibly create a fearful or a negative relationship with money. So as parents, I think you could coach them, help them see the bigger picture, but at the same time, encourage them to be savers and not necessarily spenders. If you have a spender in the family, kids, you're going to have one saver and one spender. It's just probably just the way it is. And so if you have a spender, don't just say that's just who they are and they're just going to have to learn. Instead, help them to see that there are automatic ways to save. Every month, they should just get in the habit of automatically saving and teach them that from an early age. Once they've learned that they can save and forget about it and have that consistent habit, after that, they're free to spend what they have. It just might take you a little bit more coaching if your child just happens to be the spender. Anyway, as I said, I could go on and spend the whole time about this. I think what I might do is just skip forward and talk a little bit about the difference between an RSP and a tax-free savings account. Most people often ask me this question, when would you use a tax-free savings account and when would you use an RSP? So I've tried to put up a table that walks through some of the similarities, some of the differences about them. For example, you can name a beneficiary on both accounts. And there's also a set amount that you can contribute. You should note that if you don't make that contribution in that calendar year, that for both accounts, that amount carries forward. For contributions made to an RSP, that amount is tax deductible from your annual earned income. TFSAs, it's not tax deductible. But when you pull funds out of an RSP, it's taxable. But a tax-free savings account it's truly what it's called. It's a tax-free account. You don't pay tax on the growth or the withdrawals. And an important distinction is with an RSP, you actually have to have some kind of earned income. A tax-free savings account, you don't. You literally just have to be Canadian and at least 18 years old. RSPs, the purpose is really retirement. You could use it to save for your first home as well. And a tax-free savings account, it could be long or short term. You could save for retirement with a tax-free savings account. With my wife's tax-free savings account, as an example, we have called it the cruise fund. We called it that pre-COVID. We'll see what cruise looks like down the road. But the reason we call it the cruise account is because we were planning on using her tax-free savings account for when it's just the two of us and we're empty nesters and we want to go on a holiday. We're going to use the tax-free savings account to pay for that. Now, the important question is which account should you use? Notice they put a check mark in both of those boxes. I think there's a great purpose for both of them. I just want to tell this quick story about myself. I've never been a very handy guy. I'm not particularly gifted in that particular area. And when Becky and I first got married and bought our first house, I didn't even have a toolbox, but I did have one hammer and one multi-head screwdriver. That was it for my toolbox. When you retire, I don't want you to be like me and just have an RSP inside your toolbox. An RSP is great. It's certainly a really, really great blessing and wonderful account to use. But by no means should it be the only account that you use. If you retire and you haven't fully funded your RSP over the years, that's just fine. If you have other accounts like a tax-free savings account or a non-registered investment account, that's great. But trust me, when you hit retirement, you do not want to have all of your funds inside an RSP. It will make your retirement that much more expensive. Every dollar you pull out, you have to add on average about 20 to 30 cents just to pay the taxes. One rule of thumb that I tend to use is which account would one person use if you could only invest in one? I generally say if your income is going to be higher in retirement than it is presently, use a tax-free savings account. And that's because if you pull your funds out later on in retirement and you're in a higher income tax bracket, then the tax deduction you received while you were younger will basically be eaten away by the taxes that you will have to pay later. And our tax-free savings account will give you the same tax-free growth that you will get from the tax-deferred growth in an RSP. Scott, maybe I can just pause it right there to see if there's any questions on any of these topics.
Well, thanks, Steve. Let me just have a look and see what we have for questions. There is a question here about like how to teach your children. What specific tools or tricks do you use to help them understand the concepts of basic finances and like what even debt is and why a person would have debt? Now, Steve, you've got children. What do you do to have these conversations with your children?
I think it's important, and maybe we could go back to the one slide that talked a little bit about helping your children learn about finances. One of the ways that I try and help our girls is I try to involve them in financial discussions. We try and even bring them in specifically to talk about the cost of their extracurricular activities. Basketball will cost $200 and some odd dollars. Ballet will be, 130. Piano will be this. I also try and talk to them a little bit about the cost of vacation planning. And I think it's important that and maybe I'm wrong on this, but I try and show my children what our banking looks like. I log in, I have no qualms with them seeing the balances in various accounts. I personally am a goal-based saver. And so if you were to log into my banking, you would see that I have about 6 savings accounts. Seems a little extreme, but for whatever reason, it gives me joy to have them labeled for various things, and I put money into them. And one of the things I like to do is when we do pay for a holiday, I like to show the kids, look, I moved funds from the savings account into the checking account that then goes on to the credit card because dad and mom just paid for plane tickets or just bought, just rented a hotel. And so they can see that we have the money saved up and that we are using it and then I'm paying it off. Another thing, and I didn't really touch on this in this particular slide, but I think it's important that you teach your children to be wise spenders or good shoppers. In my case, I'm not a great shopper. I don't particularly like it. I view it as a necessary evil. And so I'm not the best teacher. In our house, Becky, my lovely wife, is certainly by far the best teacher. She always asks, do you need this? Why do you want it? A lot of times, especially for the older kids, they feel like they need it or want it because someone else has it and it looks appealing. And so we just try and discuss, why do they really want it? Could they comparison shop? Could they be patient and wait? Do they want to watch for something go on sale? And then I try and exhibit that behavior myself. I've been looking for some cargo racks that go on the back of my truck, and I knew that they would go on sale. And sure enough, Princess Auto put them on sale, and I mentioned to the kids that finally these are on sale. So I try and practice what we preach as well. Certainly, just for the record, I'm not an expert in this field. I'm a portfolio manager by trade, meaning I like to look at stocks and review balance sheets. I am a financial planner, but I don't specifically focus on helping children learn. This is not my specialty. It's just been from my own personal reading and my own trial and error with my 4 children. But I would say, just to sort of summarize on that, showing your children as much as you're possibly comfortable with about your banking and what you're doing will educate them, and understanding their personality and helping them to work around that would probably be 2 really good things to do. I did want to talk a little bit about, should you buy a house or rent a house? I never thought that this would be a topic, frankly. I always was raised to understand that as soon as possible, you go out and you buy a house. But there's a lot of things to consider now, and a lot has changed over the last 10 years. Things like the CMHC fees are very costly, and they have gone up. If you're trying to avoid that and you need to come up with a 20% down payment, well, that could take a very, very long time to come up with, say, 50,000 to 100,000. Yes, you can use your RRSP, but you do have to pay that back eventually anyways. An interesting stat is that the median single family house, or excuse me, the median income for a Calgary family in the past 20 years has gone up by 73%. That's pretty outstanding growth. I'm really happy that my fellow Calgarians have seen that kind of increase in their income. However, the median single family home in Calgary over that same time period has grown by 189%. That's staggering. So if you're to compare the family 20 years ago to today, there's a big difference in what you have to spend in order to buy the same comparable house. So I don't think it's very simple anymore. I think what you have to do is, frankly, educate yourself. This might sound silly, but there's a lot of really great YouTube videos out there that show the math as to why renting is just the better choice. I work with a very lovely and very bright lady, and between her and her husband, they've determined that, at least for the foreseeable future, they plan to rent because it meets their goals. So as I mentioned at the beginning, there's a lot of variables to consider. Interest rate, house prices, your income, your long-term goals. Will you be moving in the next, say, 5 to 10 years? So it's not quite as simple as it used to be. And so my recommendation is that you meet with a financial planner, you become educated on it, and you really seriously consider what your longer-term goals are. Another important topic is, how do you save for your child's education? There's a couple of ways. I think the most important way, and the way that I'll probably focus on, is the RESP. And RESP, oftentimes when I bring that up during these types of presentations or to friends, they say, what is that? RESP stands for Registered Education Savings Plan. It's set up by the federal government a number of years ago. Essentially, it allows you to contribute up to $50,000 per beneficiary and receive approximately $7,200 in grants. I say approximately because it varies based on what your income are. There is one particular grant that everybody qualifies for, but then there's other grants and bonds, and depending on the province you live in, you can qualify for other types of grants that could also help. Some of you might remember during Alberta's glory days, not that long ago, there was what we called the ACES grant, the Alberta Centennial Education, I can't remember what the S stands for now, but essentially it gave people who were born in 2005 or later X amount of dollars, and then on certain birthdays. Now that the Alberta government's plunged itself back into debt, they scrapped that. So we no longer have that here in Alberta. Advantages of a RESP is the money grows tax deferred, not tax-free, tax deferred. I'll speak a little bit about that in a minute. There's also a wide range of investment options, and you can use a family plan. So if you have 2 or more children, you can have one plan and have all the children as beneficiaries in the same plan. This is great because let's say one child goes to a 16-week program and that's it for their post-secondary. Meanwhile, the second child does an undergraduate bachelor's degree, then a master's degree. Well, you can focus the additional funds that didn't go towards the one child who did the 16-week program into supporting the child that did the much longer, say, 6-year program. So I talked about how the money grows tax deferred. So when the funds are being pulled out, all the original contributions, since that they were contributed as after tax dollars, they get to come out as tax-free. If there's growth, and there will definitely be grant, that is taxed in the hands of the beneficiary. Ideally, the beneficiary will probably have next to no income. They'll be in school most of the time, and chances are they'll be in the lowest tax bracket. And so in some cases, you can possibly assume that the funds will grow tax-free because as they're pulled out at a very low tax bracket. I just want to talk a little bit about the withdrawals. This is often something that causes a lot of confusion. Again, I could go into this topic for about an hour, but I'll just keep it brief. Essentially, you can use an RRSP for most types of education programs. The government has laid out what those are. If your child is going to university, college, some type of trade school, if they are going to do a program that is 13 weeks and it's going to teach them how to paint nails and do hair and that type of trade, that qualifies. So you also just need proof of enrollment. Usually the first 13 weeks is a little bit tougher. There's limits. You can only pull out $5,000 of growth and grant. Growth and grant is equal to the EAP. But the contribution amount, you can pull out as much as you want. Work with the RESP provider to make sure that in the beginning years, you're withdrawing as much of the EAP as possible. You want to make sure that all that's used up in case that you have funds that are left over in the RESP and your children are done educating themselves, because that EAP could be taxable in your hands, but the contributions won't be. So you want to make sure you pull out as much of the EAP as possible. Scott, maybe we can just pause here, and I'm sure I probably created some questions here. Are there any questions that people might want me to answer?
There's a question about RESPs. Do you have to make consistent payments along the way, or can you make lump sum payments? And what if you can't keep up a specific schedule? Does that matter?
No, you're not expected to make any kind of payments. You don't have to make any contributions ever to an RSP. Really, you contribute what you can afford and within what your contribution limit is. Your contribution limit will be found on your notice of assessment you'll get shortly after you file your taxes. I encourage everybody to get a CRA account so they can log into CRA and they can look up everything regarding their taxes. This is really great. It's very convenient and you can connect it to your online banking sign-in, so it's very secure. But you don't have to continue to contribute. Sometimes clients contribute more in some years than others, just depending on what they can afford.
And can you self-manage the funds that you contribute to an RESP, or how does Is there any rules or restrictions about that sort of thing?
Yeah, that's a great question. You'll often hear the term self-managed RRSP. Um, you don't see them very often anymore. This used to be common in the 80s, where there was these RSPs that were kind of like a pension plan, and clients would, or investors would hand their funds over to this managed RSP, and then it was just managed for them. It was like this sort of private pension. You don't see those very often. Most accounts are self-managed RSPs. Sometimes I get a kick out of it when we're opening up an RSP for a client and it says right on the statement or on the forms that this is a self-managed RSP, and they say, well, are we hiring you to do this? It just means that you have say over how the investments are managed. So yeah, you can open up RSPs in a variety of institutions. There's robo-advisors, there's self-direct, there's financial advisors, there's mutual fund advisors, there's portfolio managers. There's a variety of institutions and options when it comes to opening up an RRSP.
Great, thanks, Steve.
You're welcome. Let's move on. One of the things I wanted to talk a little bit about was, what advice do you have for someone who's starting out? And I prepared a couple of these points, and they might be maybe a little too philosophical, but I thought I'd review them anyways. Point number one is that no one will ever be as interested in your finances as you are. And I think it's crucial that you consider yourself to be not a saver, but a wealth builder. And I know that might sound like semantics, but there is a difference there. Our clients who are very successful spend a portion of their time on a regular and consistent basis managing their wealth. They take it, they don't take it for granted, and they take it very seriously. And they work very closely with us in terms of how they're actually going to grow their finances. Another point is, I always like to use the term grow where you're planted. In other words, just be consistent. Pick a plan and just stick to it. And it's really consistency that really pays off. I think it's important that you pay yourself first. That's like another way of saying, pick a saving strategy and stick to it. I like to talk about paying it back and paying it forward. There will be times where you can pay it back by giving to charity, and paying it forward, helping someone else out, just giving back, really, contributing to charity in one way or another. I've talked about that before. If you get in the habit of that, there's something that we have noticed in our clients and in my own life that just makes us happier. Another point is the only place success comes first is, or the only place success comes before work is in the dictionary. A lot of times it will take you a number of years before you really begin to see results in terms of your saving strategy. And then you'll just be amazed. It just takes a life of its own. Education, continually learn. I love continuing to go online and read topics. Thankfully, the institution I work for has a very strong wealth management department that publishes great articles. There's lots of continuing education courses. And I like it when clients come in and just ask me questions. I think it's really important that you get in the habit of living within your means, or in some cases, you might say living below your means. In other words, if you spend less than you earn, you'll just be successful. The next point is be prepared. There inevitably will probably come a time where you might be laid off, where you might find yourself out of work, or where you might find yourself in some sort of medical care. Being prepared means having funds set up for a rainy day, having insurance in place, having a will in place, and being prepared for something that will be completely out of your control. So, as I said, I know those are sort of philosophical in nature, but I hope that they will ring true with you. Another topic I want to talk about is, what does estate planning really mean? And who should have a will is a question I often get asked about. And the answer is, in my humble opinion, every adult should have a will. And we often just talk about a will, and we don't talk about power of attorney or even personal directives. A will deals with a person's assets after a person's passing. Power of attorney deals with a person's finances during incapacity. They've had some sort of medical issue. They are not able to make decisions regarding their finances. Or in some cases, sometimes that person is out of country or tied up for some particular reason. A power of attorney can come in and make decisions regarding the person's finances. Personal directive is looking after a person's healthcare choices when they're not able to do so. I just want to spend a little bit of time talking about death and taxes. I'll jump to the second point on the slide where I say you are not going to discover some kind of loophole. Oftentimes I get calls from a client saying, I'd like to add my fill in the blanks to my account so that when I pass, we don't have to pay taxes. Well, if it was that easy, everybody would be doing it. I am certain that the government has come up with pretty much every way to shut out those type of loopholes. If you're looking really for ways to minimize your taxes, I would suggest you go and see a tax professional. Don't take the advice from somebody that you're having coffee with, for example, that their neighbor's son works for this company, and at that company, a guy told him about how he helped his parents. Those things rarely work and are probably not as good as they sound. I also want to talk about beneficiaries on registered accounts. This is a really, really important topic to me, and I take it really seriously for some reason. A lot of times, well, first off, if you're married, you should appoint your wife as the beneficiary of all of your registered accounts. Say your tax-free savings accounts, your RSPs, your locked-in retirement accounts, maybe a RIF or a LIF, anything that you can appoint a beneficiary on. And if you're married, appoint your spouse. But in the cases where you might not be married, a lot of times people say, well, I'm going to save money by naming my mom or naming my sister. So what happens is, if you have an RSP, and let's say that's your major asset, you have an RSP, when you pass away and you've named your mom as the beneficiary, that RSP goes directly to your mom. For easy math, we'll say there's 10,000 in there, okay? That 10,000 will go directly to your mom as 10,000. Well, guess what? Your estate is on the hook for paying income tax on that $10,000 withdrawn. If that's the only thing that's in the estate, where's CRA going to get their money from? You can't escape paying the probate tax. And in Alberta, it's not a big deal. It's like $500. It's not expensive. You also can't escape paying the income tax on it. And so in my humble opinion, if you don't have a spouse, name your estate, get a will, and in the will, basically lay out where you want your funds to go after the government, the CRA, has gotten their portion for taxes. It will be much cleaner. Everybody will be better off, and your tax bill will not change by naming the estate. I can assure you of that. Scott, are there any questions about any of the topics I've been reviewing?
A question about people who contribute is there any benefit or drawback to contributing at work or through their own self-managed or through an investment advisor like you? Like, is there any benefit, or is it all the same kind of a thing?
Yeah, generally the rule of thumb is, the convention is that companies will match contributions and sometimes even add to that contribution. Uh, Typically, our rule of thumb is you want to contribute just the right amount to receive the maximum amount of matching from the company. Typically, the fund, the RSP, will be housed at, usually it's an insurance company like, say, a Sun Life. And depending on the size of the company and depending on how generous they might be and what they want to pay for, the investment options could be wide ranging or very limited. If you work for a small local company that has set up a group RSP plan through Sun Life, chances are they might only offer maybe 5 or 6 investment choices, because one of the advantages of using a group plan is almost always the company will cover the expense of administering that plan. So you're not paying fees on it. So you generally can do, you don't have that expense. So those funds stay within the account and are growing. So that's one advantage. The other advantage, of course, is the company is going to match. Sometimes clients will have the option to move funds, usually annually, out of their group plan and into their own self-directed plan. And if you're in one of those plans where there's very limited options, maybe 4 or 5, say, ETFs, or maybe 4 or 5 mutual funds, maybe you want to move those into your own self-managed account so that you can change up your investment options.
Thanks, Steve. Another question, just quickly. Some people wondering if you could explain a couple of terms that you've used: beneficiary and probate. Can you just quickly explain those and then ready to move on?
Yeah, absolutely. Yeah, sorry. Sometimes I just get into financial lingo and take for granted that some of these words are obscure to probably the average investor. Beneficiary is anyone that you appoint for a registered account and for life insurance, and for RRSPs actually too, to basically receive the funds. Excluding an RRSP, they would receive the funds at your passing, and usually in a tax-free manner. So naming a beneficiary, as I talked about, it's usually best just to name your wife or your husband. If that's not an option, I prefer not to name a beneficiary and to have the funds go into the estate. Probate is, there's some interesting history in there, and if you have some time, you might be interested to Google the history of probate. But probate basically means that throughout a person's lifetime, they may have drafted and signed off on one or more wills. The last will is the will that the courts want to use. So the process of going through probate is really the courts will review the application and will prove that this will was truly the person's last will and testament. Probate fee here in Alberta is a flat fee. It's $400 to $500. It's inexpensive. Other provinces like BC, Ontario, the Maritimes, it can get quite expensive as it's a percentage of the person's estate. But essentially, probate is basically the court's process of determining that that will was actually the person's last will and testament. And the reason we do that is in case anyone says after, the beneficiaries, the heirs receive their portion, somebody can't come and say, look, I've got this will and it was all supposed to go to me. The courts can say, no, we've granted that this was the last will and testament to that person.
All right, thanks, Steve. No
Yeah.
more questions at the moment. You can carry on.
Okay. Well, I actually whizzed through my material a lot quicker than I thought I would. The last part that I just wanted to speak a little bit about was a quote from, he's actually a member of our church, in one of our senior leadership positions, and I'll just read it, even though you can see it on your slide. It says, "We might ask ourselves, living as many of us do in societies that worship possessions and pleasures, whether we are remaining aloof from covetousness and the lust to acquire more and more of this world's goods. Materialism is just one more manifestation of the idolatry and pride that characterize Babylon. Perhaps we can learn to be content with what is sufficient for our needs." And I just want to really encourage people to really try and avoid consumerism. If you're going to spend money, I really believe that your greatest satisfaction will come from spending money on things that create memories as opposed to collecting things. Spending time with your family, with your friends, loved ones, and doing the things that you love, I believe will ultimately bring you the greatest joy. And spending money on your efforts to allow you to do those things will create a greater satisfaction than just going to the mall and purchasing something, maybe the latest dress or the latest gadget. Um, I think that there's some real contentment in life, especially in this very secular, materialistic world we live in, that just being content and grateful for what we have will certainly go a long ways to lifting us up. Now, if there's no more questions, I did want to keep this to about an hour, and I'll go back to where I began, which is, I hope you got at least one idea. I hope you wrote something down. I hope you'll take action on this. If you don't know where to start, ask somebody. I think that chances are you are smart enough and bright enough to come up with a plan, and there's enough material out there to come up with a basic plan of things that you want to do. And keep in mind, Rome was not built in a day. It'll take time, but just be consistent. So Scott, if there's no more questions, thank you very much for this opportunity.
Thanks, Steve. Really appreciate you spending your time with us today. I hope it was a benefit to all those who participated, and we'll sign off now. Thank you very much.
Okay, thanks everyone.